we have chapter 1, and we're going to talk about the equity method, but we're also going to talk about the different categories of investments. Well, one thing that the CPA exam, I imagine you guys are somewhat interested in taking it. One of the things that they often do is they have multiple choice questions, and they'll say, hey, either what kind of an investment is this, or they say, how do you account for this investment? And you have to know what category it's in to know how to account for it. So one of the things is identifying assets, investment assets, and seeing which categories they actually go into. We're going to be more concentrated on the equity method, which is one of the methods that obviously we're going to cover. But it could also be that you're looking at, if you take the CPA exam anyways, any number of different categories that have that are for the investments. Okay, so let's take a look here. Okay, you'll notice the investment categories we have. Debt securities. So this is, for instance, a company issues bonds that they have to pay off. So they're borrowing money. Or equity securities, that's when you actually buy ownership in the company. And you'll notice something here. The debt securities, we have criteria for it, these obviously. But down here, we have rules as far as ownership is concerned for the equity securities. And there's a good reason for that. And that is that debt securities, you don't actually own any of the company. Debt security, if you buy, so for instance, IBM, if you buy bonds for IBM, that does not make you an owner of IBM. You basically have lent money to IBM, and IBM is going to use it for whatever IBM does. So, if you buy a bond from a company, that is not ownership. It's an investment to you. You're hoping to make money on it, but it's not a ownership investment. If you buy stock of IBM, that is ownership. Okay. All right, so let's see how these usually go. So debt security is usually bonds. Our debt that's purchased by the company is an investment. They receive principal and interest on the investment. Possible categories: held to maturity. So if they're 30-day notes or 5-year bonds or 10-year bonds or whatever they are, if you're going to hold them the entire time, the method you're going to use is held to maturity. There are also going to be trading ones. Let me put something. So this would be e.g. Trading investments are investments that can be sold at any time. So you could sell them today if the price of those bonds hits a certain level, you'll sell them today. And available for sale are bonds that will be held. They won't be sold at any time, but you're also not going to hold them for the entire life usually. So let's give an example here. Okay, so held to maturity means you're gonna hold them for the entire time. Trading ones can be sold at any time. Available for sale is that you're gonna hold them for longer. You're not gonna sell them immediately, but you're not gonna hold them for the entire life of the bond either. So you're not gonna hold it for the entire life of the thing. Now, one thing you'll notice about this, and this was something that was kind of unusual when these rules came out, is that you basically have to talk to management to see what their intent is. It all goes by what management's intent is. So you talk to people in this case, probably in finance or something like that, and say, how long are you planning on holding these bonds? For the entire 5 years or for 2 years, or are you going to sell them at any moment? So, management intent determines which method you use for those, which I know sounds a little strange, but it is what we need to go by. And it was strange when these rules came out back in my day. It was just investments. We didn't worry about what management intended to do with them, but now it's a little bit different. And quite honestly, it's better that you have some idea of what the plan is for the investments. Okay, equity securities, and this is what we're going to focus on in this class. Okay, so equity securities that are purchased by the company receives dividends, have gains and losses in sales, unrealized holding gains and losses, all of which are included in income. Okay. The fair value method. The fair value method is new, and that is that at the end of the year, you look and see whether the investment has gone up or down in value, and you record that gain or loss. So if the stock price goes up, you record the gain. If stock price goes down, you record the loss. Right. So that is, basically what you do for the investments that are what they call the fair value ones. These are generally non-influential. If they are influential, they are the equity method. And if they're controlling, they are what we do consolidations. Consolidations are when you take two companies and smash them together. So those are really the rules for it. The rules as they're shown is if you are non-influential, you use the fair value method. If you're influential, you use the equity method, which we're going to talk about. If you're controlling, you're going to do consolidated financial statements. Okay, now, when they came out with these standards, they gave some examples, and those examples use percentages. And one of the things about US standards that sometimes happens is that those examples become part of the rules. The real rules are, though, that if you're non-influential, fair value method. If you're influential, use the equity method. If you're controlling, more than 50%, you use the consolidation method. But when they came out with these rules, they gave examples, and the examples they came out for the equity method was 20 to 50%. In the examples. Now, here's the thing. It is possible that if you have 20 to 50%, it's possible that you are influential. For example, a large company, if you own 5% of the stock of, say, IBM, you're very influential. You probably have, you probably have people on the board of directors. You probably have at least one, maybe two people on the board of directors. You're very influential if you have 5%. On the other hand, maybe you own 40%, but there's another group that owns the entire other 60%. And they do whatever they want because you get outvoted every time. So it is possible that you're in that 20 to 50% and you're actually not influential. Or, it could be the other way around too. They actually said that if the actual rules say that even if you own 40%, but you control the company, it's considered a consolidation. You should do a consolidation because in some cases you can control the company with 40%. So, the percentages are there. If you don't know whether they are actually influential or not, use the percentages. If they tell you though whether they're influential or not, then you go by the real rules, which are non-influential, influential, and controlling. Okay. So again, these are just kind of guidelines here that are actually not part of the true standard, but they have become over time. And so this equity method is one that we're going to kind of focus on today in this class, but it's actually going to go through all of the rest of the chapters, even for consolidations. And here's why. Consolidations, sorry, I'm falling on the floor here. Consolidations are done at the end of the year. But if one company owns stock in another company, throughout the year, they'll be recording things. So if they get paid a dividend, they'll record that. And so even companies that are consolidated, generally the bookkeeping is done using the equity method. So the equity method is really done for equity method stocks, 20 to 50% influential. They also use the equity method for doing consolidations usually, because it just makes the adjustments a lot easier to do at the year end. So, the equity method, it sounds like it's completely different than consolidations. Most companies use consolidations or use the equity method for influential and controlling companies. They'll use the same equity method for it. Okay, so let's go back here. All right. So let's play. Where do they go? Debt securities. Oh man, this is exactly what I just put up before. Purchase 5-year treasury bonds as an investment. Management tends to hold this investment for the entire 5 years. Which method?
Held to maturity.
Yep. I did not realize I was doing this exact same example. Purchase 5-year treasury bond as an investment for 2 years.
Trading.
Actually, trading can be sold at any time. This would probably be available for sale. Now, this next one would probably be a trading. There's a management tends to sell this investment within the next month. This would be a trading one. They're going to sell it immediately. Because they sell it at any time, basically, or within a fairly short period of time. And again, these are all by management intent. So you got to talk to management, usually finance people, and see why, what length of time they're going to hold it for. I'll tell you something funny about this too, though, is that these rules that we have for all the, basically part of our GAAP, originally it was only for banking. By the time the rules came out, banking was excluded from these rules, and everyone else had to follow them. So we got stuck with rules because they didn't like stuff that how the banking was banking companies were doing their investments. Okay, purchased 100,000 shares of General Motors stock as an investment. Management intends to hold this investment forever.
Fair value.
Yeah. Yeah, this is 1,000 shares of IBM stock is not going to be a significant ownership. And you're not going to be able to put anyone on the board of directors or anything like that. So this will be a fair value one. Purchased 1,000 shares of and management intends to hold this investment for 3 years.
Still fair value.
Yep. Number 6. I plan on selling the stock next for next month, fund next month's payroll. Yep. So you'll notice something here that the time that it takes for selling these stocks is not going to be it's not going to change the way that you account for them. Now, you will split them up on your balance sheet between current assets, those that you are going to sell in the next year, that'll return to cash in the next year, those will be current. And those that are going to be held for the future will be in long-term investments. But the actual accounting for them is exactly the same. Okay. Equity securities, some more stuff here. Oops. What am I doing? I don't know. Okay, so equity securities, purchase 25% of LiveGo as an investment. They plan on holding this investment for at least 3 years. No other information is given.
Equity.
Yep. Purchase 25% of LiveGo as an investment. Management intends to hold this investment for at least 3 years. The other 75% of the stock is held by the founder of LiveGo.
Equity.
Probably fair value. And the reason being is, the other owners will always have the last say in it. It isn't like if there was a number of different owners, if there's 10, 15 different owners, that might be you probably would be influential. But if all of it's owned, if the majority is owned by one, it's fair to say that you probably don't have a lot of influence. Having said that, it could be that there are agreements that they do have say in certain things, and if that is the case, if it is the case that part of their agreement with buying the stock is that they do have influence, then certainly it would be an equity one. But just in general, if you have a majority that is held by somebody else, one group or person, it's hard to. It would be difficult to make the case for being influential. Okay, purchase 60% of the outstanding shares of General blah, 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 blah. Management tells to hold this for 2 years.
Consolidation.
Yep. Yeah, and now truthfully though, you probably do the equity method throughout the year, And then at the end of the year, you'll take the financial statements and smash them together, which is what we'll do later on. We'll starting in chapter 2, 3, and 4. Basically, we'll do that.
I have a question.
Yeah.
So if it was the same exact scenario, but they were planning on holding the investment for less than a year, let's say like 10 months, would that just be the equity method then at that point?
Because they wouldn't be expecting to hold it. They wouldn't be expecting to do consolidated financial statements because they were going to sell it before year end, right? That's an interesting question. It would certainly be listed as a current asset. And you're probably right. It probably would be just the equity method. If it did happen to be on the books at year end, they would have to do a consolidation.
Right.
But if it wasn't, you're right. The equity method would be what you'd be using because that's what you'd be using throughout the year.
Okay.
Yep.
Thank you.
Okay, purchase 10% of General Motors stock. Management does hold this investment for 2 years. Management has 2 officials on the board of directors, General Motors.
Will this be the equity method because they have influence?
Yep. If someone on the board of directors, you have influence in the company. It's not, they probably don't control it, but they are, they certainly would have influence on it. Purchase 30% of the outstanding shares of Ford Motor Company stock as an investment, but only acquired 4% of the voting rights. Management intends to hold this investment for 7 years.
Fair value.
Yep, very good. And by the way, that is one of the Ford Motor Company, unless they changed it recently. They have 2 different sets of stock. They have stock for the Ford family, which has all the votes, and then they have all this other stock for everyone else that has much diluted voting rights. Okay. Purchase 3% of the outstanding shares of Peabody stock as a short-term investment. Management intends to sell this investment when the stock price reaches $80 per share.
Equity.
Yeah, they don't give any information about whether it is influential or not. My guess is they're probably not trying to be influential, but it doesn't really say that. So, yeah. Okay. I think let's take a break here because we're going to start talking about the equity method. I want to kind of do it too. So we'll take a break. What time is it? 6:50. How about we come back at like 7? We'll come back at 7 and then start it on the equity method. The equity method is really what we're going to focus on for this for the first chapter here. So let me put it here. I'll be back at. Okay. Let me share my screen so that. All right, so let's say be back at 7. Okay. So the equity method. Here's the idea behind the equity method. Equity method is when you own so much of a company that it changes your relationship to, say, getting dividends and the value of the company and all that sort of thing. If you own enough of it, for instance, getting something like dividends isn't going to really make that too much difference to you. And here's what I mean. Suppose I got these. Here I have these two cars, toy cars. This way. Okay, and if I own both of them, right? And if one car gives a penny to the other car, how much wealthier am I? I own both of them. One car gives money to the other car. How much wealthier am I?
It's the same.
Yeah, I'm not any wealthier. So if you own, say, for instance, if you own 100% of another company and they pay you a dividend, you're really no better off or worse off, right? I mean, you got this dividend, whatever cash they gave you, but now that company is worth whatever the dividend is less, right? So that's kind of the whole idea behind the equity method. It's when you own so much of it that things like transferring assets basically doesn't really do anything. If you're not influential, you get a dividend, you say whoopee, money, pennies from heaven. It's money coming in. It's different when you own enough of it, and that's what this whole equity method is about. Is when you own so much of it that things like dividends really aren't income to you. Again, you're no better or worse off because of them. So that's kind of the whole idea behind it. Okay. So the equity method, the income, how do you determine the income? Well, you make money when your investment makes money, when they have income. So, when you have own enough of this other company, the only way that you make money is when they have net income. When they make money, then you make more money. And we'll talk about these later, but sometimes there might be a difference in the asset values and comprehensive income. We're probably not going to do too much with that. But basically, this first one is really what we look at usually, at least initially we're going to have, is that net income. And net income adds to the value. Okay, now if you do sell it, you might have a gain or loss on the sale. And at that point, it's no longer an investment. Okay, on the balance sheet, you put the investment on at cost. If you have income, it increases the investment. This has to do with assets, but the most important one here, the most. Sorry, I didn't make cameras in the way. This one is probably one of the most important ones, and notice that it's a negative. When you get a dividend from an investment that is using this equity method, it reduces that investment. Just like for the cars, if one car gives up a penny, that car is worth a penny less. Okay. Now let's jump into a problem. It'll make more sense when you do a problem. Okay. Oh, you know what else I get is sent on the email? That is this debit and credit thing. This is also on your, on the end of this handout. But this kind of shows the what gets debited, what gets credited. You guys are, I'm sure you guys are familiar with it by now, but this is basically it. Debits and credits, while they're quirky to learn, they're actually ingenious. You know, it's a shorthand. They call them journal entry because 500 years ago they'd write out like paragraphs about what the transaction was. Then someone came up with, well, can't we just put the account in a plus or a minus in front of it? You know? And so that's when they came out with the, you know, the debits and credits evolved into, you know, we still call them journal entries. But you'll notice there really is a kind of a beauty to it, that everything we do in accounting fits into basically these 5 kind of categories. And you'll notice that expenses and assets are things we spend money on the left-hand side. And over here on the right-hand side, this is all money coming in. So we get money over here. We can sell something, we can borrow money, get money from our owners. That's how we get money. Then over here, this is how we spend the money. So it really is a pretty, I mean, it can be quirky at times, but it really is a pretty ingenious method. Okay, so we're gonna buy an investment. The investment's gonna be an asset, and it's gonna increase. Let's get a date here. Okay, so this will be an investment. And probably put equity method. Pay 35,000 for it. And what's going to be, oh, so this is an asset. Going up. And what's going to be on the other side? What do we probably purchase it with?
Your revenue.
Probably cash. So cash is an asset. Now, the revenue would turn into cash at some point, but the cash itself. So going to this thing, you know, cash is an asset. It's going down. It'll be a credit. So this will be the first journal entry, and at this point, we're just switching one asset for another. We gave them the cash, and we got this investment, 30%. So, you know, this will be the equity method. They don't say whether it's influential or not. So if they don't tell us, we're going to assume it is influential. Okay, this one's a little bit tricky. Can I get these up a little closer together? On the 23rd of May, Franco Corporation paid dividends of $5,000 to shareholders. Now, this is for the total dividends. This is to all the shareholders. Here's the question: how much of that $5,000 do we get?
%30.
Yep. So let's do the math on that one. At 1,500. I think 1,500. So okay, so we're going to pick up 1,500 of that. Hey, those are centered. All right, so our cash is going up. They sent us a check. Back to this thing, they sent us cash. It's a debit going up for 1,500. Now, equity method. The equity method says we're not any richer than we were before because our investment, our cash goes up by 1,500, but our investment's going to go down by 1,500. It's now has 1,500 less of and so that is a very different than what we're used to doing for, what we're used to doing for if it's a fair value. Fair value, you'd pick this up as dividend revenue, money coming in. This says, no, you're not any wealthier than you were before. Your cash goes up by 1,500, but you own so much of it that your investment's going to go down by 1,500. So this is kind of an odd one. Question on that? Okay. Franco Corporation reported net income of 20,000. We don't get all 20,000 of that. We get 30% of it. At 6,000? I think 6,000. Okay, so this is on December 31st. This is, we picked this up as I'm just going to put this as just investment income. Sometimes you'll see that as equity investment income, which could be more confusing, but we'll just say investment income. It goes into income at some point. And now our investment is actually worth more. I want to show you something that's a little bit strange about this method. You'll notice that the investment account is in every single journal entry. So when you do the equity method, every journal entry that you do will involve the investment account. There'll be something else on the other side, whatever it is. But every single journal entry will have the investment account involved. Oh, what would be the balance in the account? Oh, oops. Okay, well, let's see. We bought 35,000. Dividends are going to decrease it. $1,500. Oops, 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 oops. And the income is going to increase it. Oops, 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 oops. Plus 6,000. You could also have done this in a T account. And so the ending balance. Yeah. Oh, whatever that. 39,500. You want to check that. Oh, here I my calculator cam. See my calculator cam? Okay, 35,000 minus 1,500 plus 6,000. Calculator cam's all dusty. My calculator's all dusty now. So 39,500. Okay. So this is our ending balance. And again, you could have done it in the T account too. There's nothing wrong with that. Probably the more normal way to do it would have been by that. But anyway, so you'll notice that this is kind of a different way of doing it. All right. I mean, this is, you know, especially this one, this dividends being negative. I remember when I first saw that when I was, you know, this can't be right, is it? But yeah, that's the way you do it. Okay. Question on that? And again, every single journal entry will have the investment account. It's just the method. Okay.
What was the amount? $39,000. Oh,
30,
okay, 39. Okay.
yeah, 39. I think that's, yeah, I think that's right. 39,500. You may want to check that. Occasionally, students will say, where'd you get this number from? I was like, well, I'm an idiot and I put the wrong number in. Always check what I do. And so basically, it's sort of like this, you know, getting paid dividends doesn't do anything for your, as far as your profitability. You know, it's just like the little cars, you know, one penny going from one car to the other car, you're no better or worse off. However, when that investment, when they actually make income, then you make income, you know. And if you think about it, this is kind of like what happens in just a regular company, going back to your first accounting, you know, income will get added into retained earnings and dividends get subtracted out of retained earnings. This is just as if this company is part of your company. Okay. All right, so I'll be quiet for a little bit here and see if we can figure this one out. Okay, I think that's what you should have got for your numbers, man. Check it just to make sure, but so the investment, whatever you paid for it. Coming down here, though, we got the cash, we got $10,000 cash, and again, we're no better or worse off than we were before. We got 10,000 cash, but our investment is now worth $10,000 less. And coming down here, the place actually had income of 12,000, so we would get 40% of that 12,000, which I think is 4,800. Investment income of 4,800, and if you look at our, that's like kind of like this here. The income would be sort of like, the revenues or sales would be increasing it. Credit. What's the balance on the account? Okay, I'm going to show you guys how to be lazy. I'm really good at it. So this will be, let's see here. Our dividends were what, 10,000? And our income is 4,800. What is that? 74,800. Yeah. What's on that thing? Okay. Let's go to the next thing we're going to talk about is this. When you buy a regular asset, a fixed asset, say, piece of equipment or machinery or whatever you call it, it could be land, could be building, whatever. It doesn't matter what someone else had it on their books for, right? Just because they have land on their books for 50,000 back in 1962, that land might be worth $10 million today. When you buy the land, whatever you pay for it, that's what you put on the books, $10 million, right? Because it doesn't really matter that they bought the land for 50,000 eons ago. So whatever you pay for it, that's what you put on the books for. Okay, now the problem is when you buy an investment, you invest in a company that you are basically, that you own enough of it that it becomes sort of a part of your company. It could be that you're actually paying for assets that are worth more, oftentimes, than what the other company has in the books. For instance, if you bought a share, a 30% share of a company that had this land on the books, their books for $50,000 they bought in 1962, they're not idiots. And when you buy, 30% of the company, you're going to be buying 30% of that, land that's now worth whatever, $10 million or whatever it's worth. So, you will have to increase oftentimes the assets because of they're worth, oftentimes are worth more. It could be they're worth less too, that is possible. But oftentimes because they're worth more, you will have to increase your percentage of those assets. If it's land, it's not going to make any difference. But if it's something that is depreciable, if you bought something that's worth more money, but that is being depreciated, notice you're going to have more depreciation. So if the company you bought it has it on their books for $10,000, this piece of equipment that's really worth $30,000, they're depreciating $10,000. When you buy it, you're going to have to buy it based on the $30,000 that the equipment is worth. So that means you're going to have to have some additional depreciation in there, and that's kind of what this next problem is kind of highlighting. Okay, so Tom owns a restaurant. Tom buys an oven from Sarah for $700 cash. Carry value on sale. Sarah's books for 460. So notice Sarah would be depreciating based on 460, whereas Tom, it would be depreciated based on 700. Okay, so let's in here. So okay, so Tom buys an order from Sarah, so he gets a oven, equipment.
Yes, sir, we can't see your screen.
I'm sorry.
We can't see your screen.
You're right. Being stupid here. Thank you. Okay. All right. So I'm sorry. so page 7. So Tom owns it, so he buys it from Sarah for 700. So Tom would be depreciating it based on 700, whereas Sarah would be depreciating it based on 460 if Sarah still had it. So this equipment, oven, it's an asset going up. For $700. Probably paid cash for it, I assume. Yep, cash. Okay, so cash. Okay, so this is what it would look like if Tom bought the oven. Okay. Okay, so prepare the journal entry for depreciation. The oven as of December 31st, assuming the oven has an estimated life of 10 years with no residual value. Okay. All right, so the oven has a cost of $700 by 10 years equals $70 per year. Oops. By the way, the journal entry for depreciation, you can remember it by the very morbid DED, DE. Depreciation expense. And accumulated depreciation. So this would be the journal entry that Tom would be putting on the books. Right, makes sense. You bought it for 700, gonna last 10 years, no residual value, $70 per year. Now, if Sarah kept the oven, what would the depreciation balance have been, assuming the estimate, blah, blah, blah. Okay, so if Sarah had kept it, she had on books for 460. Oops, wrong number. Okay, so how much more depreciation would Tom have than Sarah? It would be 70 minus the 46 equals 24. So here's the thing about this. If, now this is just a plain old sale of equipment. But if Tom had bought into, say, Sarah's business, Sarah would have been depreciating it on her books at $46. Tom would be depreciating it at 70. Tom would have to subtract out another $24 of depreciation from the income to match up with the investment, because this equipment was worth more than Sarah had it on her books for. She had it on books for 460, it was actually worth 700. Because it's a larger amount, it's going to depreciate more. And again, you say, well, why don't we just use Sarah's number? Well, because when you bought it, part of the buying of it was that they had this increase in value of these assets. Okay, so let's see how this works out. Okay, look at this one. Look at all that stuff. Okay, the Singles Corporation bought 25% interest in the Calhoun Corporation on January 1st for $55,000. Singles is able to exert significant influence over Calhoun. Calhoun had income of $30,000 and paid dividends of $12,000. Okay, so let's see how all this works out. All right, now here are the carry values of the assets on the books for Calhoun. And here's the fair value. Here is what they are really worth. So at fair value, the fair value of these assets are calculator cam. Okay, the fair value of the assets are 30,000 plus 60,000. It's 240. It's 80. 410. Oops. So this is what we're going to use for our, when you calculate the, what we're buying here. We're going to use the fair values. And the fair value of the liabilities was the same. And by the way, you often find that is the case. Okay, so total net assets at fair value. We're going to take the 410 of the, zoom in here a little bit. We're taking the 410 of the assets. This is the good stuff. This is the bad stuff, 190 of liabilities you have to pay off. So the net assets at fair value would be 410 minus 190 is 220. Notice that is how they came up with the 55,000. Yeah. Okay, so let's go ahead and let's put in the stuff that's if you know about them, and then we'll worry about this other stuff here. So let's see, we have purchased it for 55,000, so this will just be. Oops. So this is just like we did before. Okay, they say at year end, we had net income of 30,000 and paid dividends of 12,000. Okay, so let's do, I'll do the dividends first, keep the same realm. Okay, so dividends, so we should have 3,000 of the dividends. And the other side, we have our investment. I think it's on 1231. Next, we'll do the income. Okay. So far, this is exactly what we just did in the previous two problems. Okay, now what we're gonna do up here though. Most of these are gonna be the same here, especially things like cash are usually the same. Now, this one though, the excess is 40,000. So this 40,000 are assets that we are going to have to take care of. By the way, you do the same thing down here. Usually the liabilities are exactly the same. Not always, but usually. Okay, this excess is gonna last for 5 years. So it'll be $8,000 per year. Now, this will be the total depreciation, though. This will be the total amount. Oops. Okay. Now, remember, we only bought 25% of the company, though. Okay, we're going to take it out of our investment income. We reduce it. It's like an additional expense of 2,000. And we're also going to take it out of our investment. So this 8,000, this is for the total company, the additional expense or amortization we would have. And down here, we reduce our investment income, just like an expense. Reduce the investment income by 2,000. Okay, that's a wacky one, isn't it? So it basically is here that, you know, when you bought your percentage of the company, when you bought your 25%, included in it was this extra 40,000 for buildings. So the extra depreciation per year would if you bought 100% of the place, the total depreciation of the year would be 8,000. Because you bought 25%, you're gonna take 25% of that. And it reduces your income in equity. In your related to your equity investment. You know, you pick up 7,500 of income up here, but then you reduce it by 2,000. Now, after 5 years, you'll stop doing this because the excess will be completely depreciated. Question on that thing? This would be a good place to stop. I tell you what, for homework, let's make the chapter 9 homework. Not chapter 9, problem 9. See if you can figure out this one. Homework for what's next we got? 126. So give this one a shot. See if you can figure out this one. This one will be similar to what, you know, the other one, the previous one we had. And don't be afraid to make a mistake. You know. But see if you can figure it out. Again, you have this one to kind of look back on. Question on anything? Okay. Second. All right, so here's what we're gonna do. So for today's assignment, you know, submit it here. And the ebook, I'm not going to say anything out of the ebook. The ebook's kind of wacky a little bit. Hopefully they fixed it. Let me see if they fixed it or not. It's kind of funny actually, but fix it. Nope. I'm not going to sign any problems out of the textbook just yet. You'll notice the numbering. It goes, you know, 1 through 10 is okay, and then after that, they're all numbered number 1. Problems I do. I'll do problem 1, then do problem 1, and do problem number 1 as extra credit. But so hopefully they'll fix this numbering by next class. But anyway, so for next week, try to do problem 9. Give it a shot, and we'll go over it. So don't worry about making a mistake or anything like that. We'll go over it. But you have this other one to look at to kind of use as a template. Okay. Question on any of that? I know it's the first time you've seen it, so you get a number 9, you get a little more familiar with it. Okay. Well, so that's it for this week, and next week we'll tune back in same time and take a look at that problem and go on from there. Any questions?
The thing we were just looking at, is that in the course documents? Or where can we?
The chapter, the handout?
Right.
It should be in your email. I don't have it in the course documents yet,
Ah, gotcha. Okay.
but I will. Yeah, I will put it in the course document.
I got it in the email. Okay, just making sure.
No, I apologize. By the way, in the future, if you ever don't have it, let me know. It should be in the course documents. Today, I have no excuse. I forgot to put it in, but I'll put it in momentarily in the course documents also. So
Are you gonna put a recorded lecture on
Yes.
Blackboard?
yes, this will be recorded. Now it takes, I don't know, I bore you with the details, but Zoom takes about an hour to render it, and then I have to edit it for because if I leave the front end blank, which I usually have 10 minutes of front end, it will put in closed captioning, which means it's not appropriate for schools to post that for people who need closed captioning. So anyway, it's long story short, it takes me about another 2 hours to render it, for it to render, and then it takes about another to load it into YouTube. YouTube's kind of strange. Sometimes it loads it in 15 minutes and sometimes it takes 4 hours. So anyway, but certainly by tomorrow it'll be up, and hopefully by midnight, unless something goes horribly wrong, it should be able to be put up. But yeah, so it'll definitely be posted. Definitely by tomorrow morning, it should be there. I think I put in the handout within 24 hours, but it's never taken that long to do it. So yes, long story short, yeah, it'll be in the Zoom meetings. Underneath the link to today's one, it'll be all the recorded ones will be there. So it'll be week 1 handout, chapter 1 handout will be there.
Okay.
Any other questions? Okay, well, I will see you guys next week. If you have any questions, you can email me also if you have anything. And again, I apologize for not, well, 2 things I apologize for. The beginning of class thing was a disaster, but also not having the chapter 1 handout in the documents, but it'll be in there shortly. Any questions? Okay, well, have a good rest of your evening, and I will see you guys next week.
Thank you.
Thanks, guys.
Thank you, Professor.
See you guys.